Hi, my name's Will. I work on the Officials, where we publish fair value curves at the close of Singapore and the close of Europe daily. Today we'll be discussing a little bit about the Middle East tensions, which have recently escalated pretty significantly, and we'll also be diving into what's happened to the Dubai benchmark and the Brent-Dubai differential. So recently, developments in the Middle East have had the oil market pretty concerned. Initially, hands-off, the US have become a lot more proactively vocal on the tensions. We've seen US strato-tankers have touched down in Europe. The US embassy in Jerusalem has closed, so it's really starting to look a lot more precarious. One threat from Iran has been the closure of the Strait of Hormuz. About 20% of the world's oil transits this strait, so there's been some pretty outlandish claims about flat price under force majeure here, and the oil market more generally has been pretty worried. To be clear, this is not a realistic threat, from our view at least. It's not in Iran's interest, but the illusion that it might happen is in their interest. They want higher oil prices, but they have tried it before. In the Iran-Iraq war, where Iraq attacked 283 merchant vessels and Iran attacked 168, oil still flowed. But nevertheless, hypothetically, what would happen if the strait was closed? Originally, the Dubai basket consisted only of a single grade, that was Dubai. And this left the benchmark pretty vulnerable to risks in the strait because it would load inside the strait. So other grades were added. Some were added to boost broader liquidity, but some were also to diversify loadings and reduce risk. For example, Murban loads via pipeline to Fujairah, and Oman also delivers outside of the strait too. In fact, after the tanker wars of the 80s, Middle Eastern producers more broadly rapidly looked for alternative loading arrangements. For example, the Saudis went to build the 6 million barrel per day east-west pipeline. And this has enabled a much more robust conduit for Middle Eastern grades into the market. But still under the closure of the strait, some Dubai grades would not deliver, such as Upper Zakum, which loads out of Zirku Island. Vessels that load here have to transit the Strait of Hormuz. So therefore, that grade would not be deliverable into the window. Under that scenario, Platts would most likely disallow these grades until further resolution. There is also always a force majeure clause in almost every oil contract. This enables deliveries that were subject to force majeure to either be delayed or the transactions to be unwound. So under this scenario, naturally the Dubai basket would be constrained, there'd be less supply, and Dubai would go up relative to other less affected grades. But again, this scenario is hypothetical and it's not likely from our view. But how has the market been positioning themselves? Well, we've had a quiet month in Dubai, that's for sure. This morning's window, we only had one trade. It's rare, we've rarely had more than sort of 5 trades a window. But trading activity, if anything, has actually increased since the escalation. Nevertheless, we've only had 2 convergences this month, and that's pretty tiny. Last month we had 21 Murbans alone declared. But interestingly, one of those convergences was Upper Zakum. So clearly sellers aren't too worried about issues in the straits just yet. I mean, there are bigger issues to worry about for the Dubai shorts. And again, it's all about Murban. So stay tuned for next week's video on how ADNOC is fighting back against the shorts. But back to the topic at hand. What is the impact? What has the impact been? Well, we saw physical premiums rally, as you can see on this chart, from an average of $1.26.5 per barrel in calendar May. It's now pricing above $3.21 a barrel as of this morning. But on a relative basis, Brent-Dubai could have gone either way. If the market starts pricing huge disruptions, we might have seen Brent-Dubai compress as we discussed earlier. Perhaps markets would expect the benchmark to see less liquidity or constrained supply. Or there's potentially going to be a big substitution as the market goes hands off of Arab Gulf grades, and that could see Brent-Dubai rip. Well, in the immediate aftermath on Monday morning, we saw the latter. We immediately saw tanker rates from the Arab Gulf to Asia rise 20%, but interestingly, rates from West Africa to Asia leapt up 40%. So WAF is clearly in demand, and physical differentials in the North Sea have also leapt up to about $1.20 a barrel from 60 cents last Thursday. So we've had a huge boost to demand for WAF grades and North Sea grades. And WAF is most likely clearing into Asia. So perhaps we are seeing a little bit of that substitution. Also, it's important to remember that Brent futures are much more widely traded than Dubai. A lot of hedge fund money will be buying Brent as a hedge against the geopolitical tensions, or even speculatively. Even if there is zero change to the fundamentals, they may still be buying Brent. So M1 Brent-Dubai gapped up 22 cents on market open, as the market realised that oil flow out of the Arab Gulf was probably unaffected. So we've had some pretty aggressive moves in Brent-Dubai, perhaps slightly counterintuitive, especially if you were thinking that perhaps supply out of the Strait of Hormuz would be at risk here. It's always important to remember context, what has happened in history. We've seen a lot of disruptions to shipping in the Red Sea, for example, with the Houthis launching attacks on merchant vessels there, and still vessels will transit. Closure to the Strait of Hormuz is not likely at all, and that's what we've seen in the pricing. So to wrap up, today we've been discussing recent escalations in the Middle East and how markets have been reacting to developments there. We've seen Brent-Dubai differential widen, and largely that's a result of substitution away from Dubai grades, but also speculative interest in Brent contracts. Next week, tune in for our discussion on the recent developments in Murban and how ADNOC are fighting back against the shorts in Dubai. And stay tuned to our daily reports and our X account for timely updates on the market. Thanks for watching.